Let's stick with the markets and welcome in Omar Aguilar. He is Chief Investment Officer of Passive Equities and Multi-Asset Strategies at Charles Schwab. Omar, thanks so much for joining us. What do you make of today's market action on the heels of that disappointing August jobs report? We've got a split market with strength in tech, but the Dow is having an outsized down day. What do you make of it all?
It sounds like the markets are still trying to digest information about last week and in general the trends that we have observed with the impact of the Delta in economic growth, as well as the overall deceleration of economic activity. It is very clear that the market, after running up to 20% so far this year, is trying to position themselves coming out of a long weekend of what may come ahead. With a lot of information coming in front of us, including decisions by the ECB, new data on obviously the labor market, but also the Fed meeting later in the month that may give us more sense of what may happen with monetary policy in the period of deceleration of economic activity.
Given what we saw in that jobs report on Friday, certainly it will be part of what the Federal Reserve is going to be looking at when it comes up with monetary policy at its next meeting. But should it move the needle? Should it change perhaps the conversation for the Fed when it comes to the timing of rolling back those bond asset purchases and perhaps even pumping in a little more stimulus, dare we say, into this economy?
Well, it becomes very clear that the labor market, similar to, the economy, it's going into this period of, pure imbalance between supply and demand. What the Fed is looking into and analyzing and clearly deferring their decisions of tapering or starting of the tapering program is because of this, clear imbalance between the supply and the demand in the labor force. And in many cases, it's also the realization that the pace of recovery of the labor market may not be as fast as what they had anticipated. And a lot of that has to do with the fact that productivity growth, has increased as a result of COVID. If you actually think about the automation and digitalization of significant amount of those jobs that we had pre-COVID, a lot of those jobs may never come back. That being said, there is still a significant amount of supply that, needs to be met for some of those jobs that eventually will either stay temporarily or not. And I think the Fed is trying to analyze whether or not, that trend is consistent with their expectations, and therefore the beginning of the tapering program in the views of a deferred economic growth is also something they want to have. So clearly, no decisions or non-announcements will come later in the month in September, and most likely will happen, if anything, at the December meeting.
Mm-hmm. Omar, what are you telling clients as they look at their portfolios and consider rebalancing here in the final 3.5 months of 2021, especially if we're going to get still lots of question marks regarding the Delta variant and more volatility being injected into this market?
Yeah, we were getting a lot of questions about what to do next. As I said, a few minutes ago, clearly equity markets have actually done well. Risky assets have done well. We have a lot of new information, and therefore the amount of volatility that we should expect going into the next couple of months should be much higher. Today is an important day because of the end of some of the unemployment benefits, and therefore that may translate in potential improvements in the labor market. When you combine that with the fact that the ECB may also early start the reduction of their own tapering program, that obviously, creates a different environment for clients. And therefore, what we're telling, our clients is to continue to rebalance their strategy, maintaining still a cyclical exposure because, once the Delta, variant starts to reduce its effect, we're going to continue to see that recovering phase. So staying, within the cyclical trade is still for a few more quarters will probably be good, while we'll still maintain a secular, growth in those technology names and those, consumer discretionary names that have done well pre-COVID, during COVID, and will continue to do well down the road.
And Omar, you heard just before our segment, Jared broke down how some of those Chinese listed stocks here in the U.S. are rebounding today. Are you playing there in the China market, and where do you see opportunity, if any?
Well, it's kind of an interesting, situation because I've been describing these supply and demand issues, and I think a lot of the, tailwinds that we see in the Chinese market, and especially in these Chinese names, today, had to do with the fact that we had very encouraging data on, the amount of manufacturing numbers that we saw from China, last week, and therefore, the ability for them to, not necessarily be as effective on those supply chain disruptions, and therefore that could potentially translate into better, position and better growth for those Chinese, sectors. That being said, the U.S. continues to lead the world, and we see a significant amount of onshoring of a lot of those manufacturing jobs into the U.S., and therefore, we still believe that the U.S. will lead the recovery and will continue to path that, even though, maintaining a healthy exposure to emerging markets and international continues to be, something recommendable.
All right, Omar Aguilar of Charles Schwab, thanks so much for being with us today.